Mortgage rates increased to 5.85% on average last Friday, and this is the highest levels for mortgage rates across the United States since November of 2008. Also, the Mortgage News Daily is reporting that 2022 is already the worst year for mortgage rates since 1979. I'm going to be sharing a really interesting article with you guys to share why mortgage rates increased so much on Friday and what's expected in the months to come regarding rates, because the Fed is meeting on the 15th of June. With that said, let's go ahead and dive right into the video here. So this is according to the Mortgage News Daily. This actually was published yesterday at the time of this video. It says 2022 has already had its fair share of bad news for mortgage rates. That's an understatement. But this week was not to be outdone. This is for news regarding last week. It also ended in one of the worst days on record in more than a decade. They're referring to the big increase in mortgage rates by 30 basis points in one single day last Friday. Again, the Mortgage News Daily is reporting that the average 30-year fixed rate mortgage is at 5.85%, the highest level since November 2008. And by the way, this is the best rate possible. So these are for rates for people with exceptional credit. In any case, it says here that last Friday here, the average lender increased 30-year fixed rates by at least a quarter of a point or 0.25%. That's only happened 4 other times since their daily record began in 2009. This is absolutely mind-blowing because think about this. They've been reporting average mortgage rates on a daily basis for over 10 years, since 2009. And they've only seen mortgage rates increase by more than 25 basis points 4 other times during that time period, which is absolutely insane. Also, 3 of those times were during the once-in-a-lifetime volatility that followed the onset of this pandemic. And when the smoke cleared, the average rate hasn't been this high since November of 2008. So average rates for people with exceptional credit is at 5.85% as of last Friday, 15 years at 5.12%, also VA 5.60%, FHA is at 5.5%, and also 5/1 ARMs, an adjustable rate mortgage, is at 4.95%. And here's what happened on Friday. On June 10th, increased to 5.85%, 30 basis point increase in one single day, which is absolutely insane. 1 year ago, rates were 3.08%. So the year over year change is 2.77 percentage points, which is absolutely mind blowing. And here's a chart to show average mortgage rates over the past 20 years or so. So right now, 5.85%, the highest level since November 2008. But look at the trajectory here, absolutely insane, basically going straight up this year. This year we started rates at 3.3%, so now we're well above that, and basically the rates have been going straight up. The last time we saw rates increase greatly over the past 20 years really was back in 2018 when rates increased by only 1 percentage point. So it's absolutely insane to see this huge trajectory of mortgage rates across the United States. And according to the Mortgage News Daily, 2022 has been the worst year for rates since 1979. So here's a chart showing the year-over-year change in mortgage rates. So for 2022, we have an increase by 2.5 percentage points. So basically we started the year at 3.29%. Now we're at 5.85%. In other words, a delta of 2.56 percentage points. As you can see here, the highest increases since 1979 here. I mean, look at 2021. Rates only increased by 0.5%, but in 2020 and also in 2019, rates actually decreased. And in 2018, rates increased approximately 1 percentage point. But looking back really over the past 40 years, we haven't seen this big increase since 1979, which is definitely going to be affecting home buying demand greatly. So stay tuned on that. However, mortgage rates change on a daily basis, so I'll definitely keep you posted on the channel for the latest developments. In any case, it goes on to say the following in this report here. Whether we're talking about short-term drama on Friday or the bigger picture in 2022, the culprit is the same: inflation. So May's inflation data was released on Friday, and that caused a lot of volatility in the stock market and of course in the bond market as well. And that's why mortgage rates increased by 30 basis points in one single day. It says both the headline and core CPI readings were higher than the markets were expecting. These are the inflation readings, right? Neither stocks nor bonds enjoyed the news. Here's the reaction to the CPI data that was released the first thing in the morning on Friday. As you can see here, right here, when that data was released, again with inflation numbers at 8.6%, higher than expectations and also reaching a new 40-year high. When that data was released, look at what happened in the stock market. The stock market absolutely tanked. for the remainder of the year. And also the bond market, for the 10-year U.S. Treasury note, also that yield increased greatly as well to 3.165%, the highest levels we've seen since 2018. And it says here, one of the reasons markets were so affected is the recent buzz about inflation showing signs that it might be leveling off. So for April's CPI data, it actually decreased slightly from the previous month. So there was a lot of buzz regarding that inflation might be cooling off. However, it actually moved in the opposite direction. And that's why we saw all the volatility in the bond and stock markets. And that buzz of inflation leveling out was responsible for rates having several solid weeks in May. As you guys can see here, ever since the end of the first week of May, mortgage rates decreased all the way through the end of May, but have increased greatly ever since then. Inflation also set a record high on May 31st, and rates changed course abruptly. The trend was actually fairly linear over the past 2 weeks before Friday took things to the next level. What they're referring to is this: Europe's inflation hit its highest level since the creation of the euro in 1999. This was published on May 31st of this year. And here's what happened with the yield on the 10-year US Treasury note here. So for May, as you guys can see here, the yield decreased, and that caused mortgage rates to decrease as well. We basically had a plateau effect for the 24th to the 29th of May, but when that inflation data report hit for Europe, the yield increased greatly. Also, when May's inflation data report for the US hit last Friday, the yield absolutely bounced as well. Also, when May's inflation reading was published on Friday, that caused the yield to spike on Friday as well. And the significance of this to our housing market is that the yield on the 10-year US Treasury note is tied loosely to mortgage rates. So here's a really good graphic depiction to show you guys regarding that, really ever since 1990. This is according to Realtor.com. So the dark lines right here is the yield on the 10-year US Treasury note, and the red line here is the average 30-year fixed rate mortgage according to Freddie Mac. So as you guys can see here, when we saw a decrease in the yield, we saw a decrease in mortgage rates. And you can see that across the board in general. It's not perfect, but it's fairly in line. As you guys can see, when we see peaks in the yield, we're seeing peaks in mortgage rates as well. So in other words, because the yield increased greatly on Friday, that caused mortgage rates to increase greatly as well by 30 basis points. All right, so what does this all mean going forward? Here's a really good explanation on their website here. Again, this is according to the Mortgage News Daily. It says here, we need one more X factor to help explain why things got so out of hand last Friday. That X factor is easily found in next week's event calendar. The Fed will be announcing at 2 p.m. Eastern Standard Time on Wednesday afternoon, again, that's June 15th, with their latest policy announcement regarding the federal funds rate. In regards to the Fed's announcement on Wednesday, here's what the street is expecting. And this is pretty astonishing because the probability here has been changing over the past several days by quite a bit. So the street right now is expecting by a probability of 76.8% for the Fed to increase rates by 50 basis points. However, look at the probability for a 75 basis point rate hike. That's at a 23% probability rate. But 1 day ago, that was only 8.7%. So in other words, because we saw this scary CPI data that was just released on Friday, that caused the street to increase the probability for a 75 basis point rate hike versus a 50 basis point rate hike. And it's going to be very interesting to see if the Fed's going to be pivoting and doing a 75 basis point rate hike versus a 50 basis point rate hike that was previously planned. And going back to this article here, this does not mean the Fed is more likely to hike rates any higher than previously expected because of this high inflation reading here. It doesn't mean we're going to be seeing a big rate hike. Rather, markets are more interested to see what the Fed has to say about the future path of rate hikes. And these include the popular dot plot, where the Fed uses to visually represent where each Fed member expects to see the federal funds rate in the next few years. And it says here, while the Fed has repeatedly told the markets not to read too much into these dot plots, the market never listens. With the CPI coming in hot this week, markets can't help but imagine that some of these dot plots are going to drift higher than they would otherwise have. In other words, the market's really going to be looking at whether or not each of these Fed members are going to be calling for any more rate hikes than previously planned. And it says here, in that sense, Friday was merely the market's way of getting in position for Wednesday's potentially bad news. And mortgage rates were one of the casualties, of course. So is there any hope here? It says, yes, in fact, there's quite a lot of hope. This month, CPI was rotten, but inflation is definitely taking a toll on the demand side of the economy right now. Rates have also risen so quickly that there's a case to be made for a corrective momentum building up. All that would be necessary to release that momentum would be for inflation to actually find its footing. So in other words, because inflation is so high right now, one would assume that would curb consumer demand and also that, of course, home buying demand as well, which would theoretically slow down inflation numbers. So comment below with your biggest takeaways from today's video. Also, if you guys got any value out of today's video whatsoever, then please hit the like button and greatly appreciate that. Hope you guys have an awesome day. Look forward to seeing you on the next video.